In 2024, any investor who is serious about making money in the stock market should be paying attention to the cybersecurity industry. So when I woke up in Australia last week and I saw that Zscaler had reported their Q3 and increased their guidance for the third time in a row from 29% to 31% to now 32% year-on-year turnover growth, I knew I had to revisit this company and take another deep dive. But why cybersecurity? What's so special about this industry? Well, we live in a data-rich society, right? We've all heard the phrase, data is the new oil. Data has a huge amount of value in today's world, and that value is only increasing. Take a look at NVIDIA's data center revenue. The whole world is all about data. Now, because data has so much value, anything with value is going to be prone to bad actors who are going to be malicious and try and destroy it. And if you're some organized crime syndicate, well, it's much easier to steal data than it is steal oil. It's much easier to develop your skills as a hacker from some far-reaching remote part of the world and hack companies that may have hundreds of millions of dollars worth of data. You know, these companies will reluctantly pay you a lot of money in ransom for you to not leak the data and destroy that competitive advantage that company has. We're also living in a world which is getting more and more globally tense, and I think if we see a scenario where we enter into another global conflict, cybersecurity is going to play a huge role in that conflict.
So far, we've seen over 70 government agency websites from the Ukrainian government taken down by denial of service attacks over the last week.
Now, of course, companies, instead of just hoping that they don't get hacked, they're looking for more and more cybersecurity solutions, and Zscaler is one of those companies right at the forefront of this innovative industry. So let's take a closer look at what the company does. So the way things worked in cybersecurity traditionally is you would have a firewall, and a firewall would act as a sort of like a filter to make sure that no bad actors got onto a network. The problem with a firewall now is that there is not necessarily a common point of entry for most people to access that network. It's not like everybody is in the office and the company has their one data center on premise. The world has completely changed. You know, work from home is not going away anytime soon. Cloud is a massively growing solution. So Zscaler, they're operating this cloud native platform and they have a zero trust model. So instead of having a traditional firewall, they basically acted like a moat around a castle. You know, you've got this moat, keeps the castle secure. The problem is that if someone got through the firewall and once they're within that network, they could actually pretty much do what they want. The firewall is just one barrier. What Zscaler have done is they've said, right, we're never going to trust anything, no matter how many times they have successfully got onto the network or been exploring on the network previously. We're never going to trust them, and we're always going to verify. So that way, in a cloud-based world, Zscaler acts as an additional layer of security within the network. Now, we can't talk about cybersecurity without talking about CrowdStrike for a minute, because CrowdStrike have had phenomenal results recently. And look at the share price of CrowdStrike. They are at all-time highs. Well, CrowdStrike, they operate on endpoint security, right? Now, they have also really benefited from a catalyzation of work from home, because CrowdStrike is about protecting endpoints, so laptops, phones, etc. The more that people are working from home, working remotely, the more devices that need to be protected. But this is the beautiful thing, is that CrowdStrike and Zscaler, they are operating in different elements of cybersecurity that both benefit from cloud and both benefit from remote working. CrowdStrike being operating on that end user, making sure the individual device does not get any malware or any unusual attack on it, while Zscaler complements that by sort of monitoring the entire network and making sure nobody infiltrates that network. What I'm saying is CrowdStrike is continuing to do very well. The other cybersecurity company that's doing very well at the moment is Palo Alto. Fortinet not so much, but if you look at Palo Alto, they've had good results. Their share price is near all-time highs. CrowdStrike share price is at all-time highs. Zscaler is a complement to CrowdStrike for the reasons that I've just discussed. They've upped their guidance for the third time in a row, but the share price is is actually relatively low. And when you look at it on a valuation basis, the shares actually look much more attractive than these other two companies. Okay, so let's just have a comparison. We've got the 4 big pure plays in cybersecurity here. Obviously, there are other companies that are heavily into this industry. Microsoft is a notable one, particularly competition in endpoint with CrowdStrike, but these are the sort of really big 4 pure plays within the industry. What you can see is that we've got CrowdStrike and Zscaler growing at similar rates on the top line, both with 3-year annualized turnover and 3-year forecasted annualized turnover. And then you've got Palo Alto and Fortinet, which they're larger, so yeah, you can cut them some slack on slower turnover growth, and they're also just much mature, but by no means growing slowly. As I just mentioned, I think Palo Alto is a high quality company right now, and you can see that because before, Palo Alto and Fortinet were growing at the same rate. Forecasted, Palo Alto is growing 15.8% over those 3 years annualized. Fortinet is all the way down to 12.2%, and also Palo Alto is a much larger company in terms of turnover and market cap, so they've also got that element to it. So Fortinet is sort of slipped a little bit. CrowdStrike and Zscaler, very, very similar, but if you look at the ratios, CrowdStrike have got a price to turnover of 27.8 right now, and Zscaler are back down at 16.2. Market cap to gross profit, Zscaler much better value for money. On a price to free cash flow basis, it's a little bit closer together, just because CrowdStrike have got their margins a lot more optimized, and they've got their sales and marketing as a percentage of revenue much, much lower. You know what? In fact, let's talk about that now. One thing I noticed from the Zscaler results is their sales and marketing is very, very high as a percentage of revenue, and that's the biggest catalyst that makes Zscaler much cheaper on the top line, but actually not that much better value than CrowdStrike on the bottom line and on the free cash flow line. Their sales and marketing as a percentage of revenue was 56% for Q3 of 2023. However, it's all the way down to 47% for Q3 of 2024, which is excellent. Now, CrowdStrike's target is all the way down at 28 to 33% sales and marketing as a percentage of revenue. This is showing that CrowdStrike has really built its value as its brand. It's spreading through word of mouth, and they don't need to go and do so much of that same conventional advertising. Now, what's nice about Zscaler is they've got a real mix of growth. So, they're growing at roughly 30% year on year. They've just forecasted 32% year on year growth. And their net dollar retention rate is 116%, meaning that their customers, on average, are spending 16% more than what they spent last year, right? But also, because they're growing at 30%, a lot of that growth is also coming from new customers. So they've got a really, really good balance there of both of them. If they can continue to uptick this guidance, have a good sustainable growth rate, whilst cutting that sales and marketing as a percentage of revenue, that is going to really, really help them get net profitable on the bottom line and sustain really good optimized margins on the bottom line. I think this is another one of the things that the market is giving higher multiples relative to growth for companies like CrowdStrike compared to Zscaler at the moment, just because Zscaler isn't there from an optimized net margin standpoint. They actually, and I think this is going to be a bit of a catalyst for the stock, they actually got a net profitable quarterly result of only 19 million in net profit, but they got there nonetheless, and forecasted they're going to get much more net optimized. You know what Wall Street's like, right? Once they can actually see that Zscaler can operate on the bottom line net profitable, if those new customers on the bottom end don't start to slip as sales and marketing as a percentage of revenue goes down, I think we'll be good. The advantage that Zscaler have got is that they're just forecasting 32% top line year-on-year turnover growth, right? So for sales and marketing as a percentage of turnover to go down, they only have to increase their sales and marketing by less than 32%. So they've still got wriggle room to pump more money into sales and marketing because of that really high organic top line growth. So just going back to the point on customer count, we know that they can do expand because the net dollar retention rate is 116, but we know that they can also do the land because net dollar retention rate is only expansion of existing customers. So we know that in order for them to be growing at this 32% rate, they're also landing new customers as well. What we can see though is that while Zscaler doesn't break down that total number of customers, we can see that the 100K a year ARR and the 1 million ARR, they are both growing at really fast rates. They're beating their average of 116%. And what you can see is that, sure, that growth was slowing in terms of how, the growth of the ARR in customers. However, now you can see with the 1 million, they reported 31 growth last quarter, 31 this quarter. With the 100K, 21 last quarter, 20 this quarter. So the rate of that deceleration is slowing. What I'm seeing is we saw a rebound with CrowdStrike's growth. And I think that this slowing deceleration coupled with the fact that Zscaler are keeping to increase their guidance, to me, this is really starting to point that maybe Zscaler are going to have a bit of a re-acceleration, or that they can sustain these sorts of growth rates going forward. And the fact that they are such a complement to CrowdStrike within this cloud native work from home, increasing exponential data world that we're in, it's really showing that Zscaler have got a big opportunity. Obviously, Palo Alto and Fortinet, they do operate in the sort of zero trust space as well. But just because they're not cloud native, they've got a huge proportion of their business that still makes hardware, that still makes legacy on-premise VPNs and on-premise firewalls. You're just not going to get that same growth and exposure to the new way of doing things that you are with Zscaler. The risk that you're taking with Zscaler is because they're a smaller company, they're going to have to work really hard to attract those new customers and make sure they continue to have that edge. But the beauty of it is, if we go back to that table that we were talking about a minute ago, right? A market cap to gross profit is 21. They're about to grow at 32% year on year, right? So if the share price doesn't change in the next year, that market cap to gross profit ratio is going to be 30% lower by the end of the year. In fact, if we look at the graph from FinChat, you can see that that is actually now showing a current price to gross profit of 17.3, which illustrates the point that I've just made. That ratio that I just showed you from SharePad, it's showing 21 because that was based off basically the last fiscal year 23 total gross profit based off the current market cap. This one is showing it from the latest quarter and annualizing it. So my point is that where you've got a company that's growing that fast, when the shares trade sideways, it just pushes these ratios down and down and down. And for a company to be growing at 30%, upticking their guidance, it's going to put downward pressure on a ratio that, compared to their competitors and the growth rates, I think the ratio is pretty low. For CrowdStrike to be on market cap of last year's gross profit of 36 and Zscaler of 21, I think that there's just too much of a disparity there. I think CrowdStrike is a little bit expensive. I used to be a big investor in CrowdStrike and I sold out just because the stock's really high. I don't think the risk reward is quite there. My DCF is showing it's overvalued, but this is the risk that you take with investing in cybersecurity because of the things that I mentioned earlier in this presentation. Wall Street doesn't value these investments cheaply. All I'm saying is looking at the valuation of Zscaler and looking at the upward revisions in guidance that they're now showing and showing that the deceleration in their growth is stopping and maybe we'll even see a slight turnaround to upward growth. I think that this is one of the best value times to buy this stock. Now, I've done a sort of base case DCF based off what the analysts are showing, based off prolonged growth, which is quite sticky because I'm very bullish on this industry overall. But that is pretty much showing that Zscaler shares are fairly valued at the moment. Now, I don't often see that, and I've been making these DCFs for these companies for a while. It's very seldom that I actually could make a DCF of a company like Zscaler and take it as undervalued. So what I'm saying is that you're not going to have a situation here where Wall Street is sleeping on this company. They know that cybersecurity is a really good industry to be invested in. Zscaler is in the Nasdaq 100 already, as are most of the other names I've already aforementioned. So Wall Street are not going to sleep on it. When you look at the valuation on an absolute basis, it's never going to be cheap. All I'm saying is that you can make a DCF that is not too crazy or too optimistic or too out of the water and actually get Zscaler shares at fair value. For me personally, the way I do my DCFs, I can't say that about CrowdStrike or Fortinet or Palo Alto right now, and I also can't say that about Zscaler's pretty much entire history as a public company, with maybe the exception of when it was trading at like $130, $140 this time last year. Now, a couple of other things to consider. Another reason why they're not doing so well on their net margins at the moment, that stock-based compensation as a percentage of revenue is really, really high. It's come down a little bit. It used to be at nearly 40%. It's now about 26, 27%, but it is pretty much the highest stock-based compensation as a percentage of turnover in the entire NASDAQ 100. However, you can also say that it's one of the smallest companies of a NASDAQ 100, which warrants that ratio to be higher, and it's also one of the fastest growing companies of a NASDAQ 100. Actually, when you go 3-year forecasted annualized turnover, Zscaler is the 5th fastest growing company in the NASDAQ 100, along with its complement, CrowdStrike. This is causing share dilution of about 4% a year, which is not exceptionally high considering the growth rates that we're talking about here, but that's another consideration to have as an investor. So that's basically my 2 cents on Zscaler. I think that with that continued transition of working from home and cloud security and the fact that data is getting exponentially more valuable all the time, if the world gets more hostile, cybersecurity attacks are not going anywhere anytime soon. Zscaler is a really good way to pure play this because it's a cloud native platform. They're still a young company. They're still growing incredibly quickly, so they've got all of those boxes ticked. They just need to ensure that as a smaller company, they can maintain their competitive advantages and stay ahead of Palo Alto and Fortinet when it comes to the network and zero trust model, and make sure that they can both continue to land new customers with sales and marketing going down as a percentage of revenue, and also that they can continue to upsell more complex and necessary cybersecurity solutions to companies over time. The last thing I just wanted to mention is here we've got a chart of Zscaler in black. You've got the S&P 500 in blue and the NASDAQ 100 in red. Now, anyone who's used to comparing these graphs, like, it's quite difficult to believe that those are the S&P 500 and the NASDAQ 100. And that's my point, is that Zscaler is a very, very volatile company, which can go either way for investors. You know, you can clearly see that here, the share price is not too high considering the somewhat exuberant prices that it was at back in 2021. I actually made quite a bit of money buying put option contracts on Zscaler back in 2021. Purely from a valuation standpoint, it was ridiculous. But now we're at the point where I think they're good value. My point is just be aware of that volatility. The share price is low. It's not stupidly low. It's not something that I would go in guns blazing with like a huge position in the portfolio. But, you know, just remember, if you start a position and then the stock continues to go down, you could get a really, really good price very quickly. You know, if Zscaler get below 150, you get a very, very attractive valuation all of a sudden. So it might be, let's say you buy at 180, if it goes up to 220, you think, like, this is a bit hot now. We go out in a relatively short time frame. But also if it goes the other way, then there's optionality to double down on that position, so long as the thesis is not damaged and the fundamentals haven't deteriorated. Honestly, don't take my word for it. This is just my 2 cents on Zscaler as a cybersecurity company. Hope you enjoyed the video, and I'll see you for the next one.